Hi, my name is Jason Lee, and I'm the founder of a company called Silent Innovations, which automates legal agreements for small businesses. I'm also an attorney, and with Michigan SBDC's encouragement, we created this video and the website so that Michigan entrepreneurs can form new businesses. In this video, we'll talk about what type of forms of businesses that's available to be created in Michigan. Now, we're not going to go into details about all different types of forms, but we'll cover four major types of entities that should cover majority of the cases. And in later videos, we'll delve into LLCs, which will be the central focus of this video series because of the various advantages that it provides to the companies. So let's get right to it with the four common types of the businesses that you could form. The first type is the sole proprietorship. This is by far the simplest because you don't have to do anything to be a sole proprietor. You don't have to file any documents or provide any notice in any form, but you probably will need to file a DBA. DBA stands for doing business as, and sometimes it's called assumed name in Michigan. And that's because people generally don't do business under their given name. They generally want to have a professional sounding name of a business. So the thing I would note about doing business as the DBAs is that you have to file them at the county level and not at the state level, which is the case for most of the other documents that you have to file with the government. Sole proprietorship, you are literally the company. So there is no legal or tax distinction between you and the company. And the way it works out during tax time is that you would file the form 1040 and attach a schedule C to disclose the profits and losses of your business. So the good part of sole proprietorship is that it's simple to create and the taxes are relatively straightforward. The bad part of sole proprietorship is that since there is no legal distinction between you and the company, there's no limited liability. So if you invest $10,000 in your company and you ramp up your business, you get a credit card, buy laptops and equipment, you enter into a lease, you enter into a contract with vendors on credit, and you rack up, say, $25,000 worth of merchandise and so on. And for whatever reason, you don't sell the inventory fast enough, whether it be due to poor marketing or COVID or whatever it may be. Uh, and when you cannot start to pay the bills as they come due, now you are exposing all of your personal assets like your house, your cars, savings account to your business's creditors. Now, this is different, say, from if you were to invest $10,000 in Ford stock, for example. Now, we all know that that $10,000 is under risk, and you could lose $10,000 if Ford goes bankrupt. But you know for sure that Ford's creditors will not come after you. And that's what I mean by limited liability, that you could lose your investment in a company, but not beyond that. And because sole proprietorship does not provide this limited liability, I generally do not recommend people to do business as a sole proprietor, especially because getting a limited liability company in Michigan is very affordable. It's only like $50. The second form that I'll discuss is a partnership. Partnership is another form of a business that you don't have to file any paperwork to create. And you'll generally see a pattern in this, so that if you want some sort of a limited liability, you need to give notice to the world that you are a limited liability entity by typically by filing some sort of a document with the state of Michigan. Anyway, the partnerships are formed very easily. It could be done obviously through a partnership agreement, but it could also be done orally. And the very act of doing business together could be deemed as a partnership as well. So let's say if you start to do business with your college buddy without doing anything formal, like entering into an agreement or filing any document, then you may have formed a partnership unbeknownst to you. This is something called de facto general partnership, and sometimes called an accidental partnership. And this is not necessarily a good thing. It's actually pretty bad because general partnerships, like sole proprietorships, they don't provide any limited liability protection. But even worse, partner could be held 100% responsible for another partner's actions. So if they get sued and they lose the lawsuit and have a judgment against them, then another partner could be responsible for that. And this is called joint and several liability. Now, there are other forms of partnerships out there, like limited partnerships and limited liability partnerships. And those two are two different animals, by the way. But I'm not going to go into the nuances of different types of partnerships here. But one thing that I'll note is that if you want the type that limits liability, guess what you have to do? You have to file some form of a document to the government. So let's say you want to go into a partnership with a friend and intentionally this time, either it be a general partnership or a limited partnership, then what you would want to do is enter into a written partnership agreement and obtain a tax identification number from the IRS. So regarding tax, it's important to remember that all the accounting gets done at the partnership level. So all the money coming in and money going out and profits and losses, they're all determined at the partnership level. And then when they allocate the profits to the partners, then that's when they pay their share of taxes. So for example, if the partnership earned $100 in profit and you are the 50% owner of that partnership, that $50 profit will be allocated to you and you would pay tax on that. The way it works is that the partnership is going to file Form 1065, which is the tax return form for partnerships, but they will not pay any tax with it. So they're going to file the paperwork but not pay any tax. And then the partnership will also prepare Schedule K1, which shows each partner's share of their profits. And using this information and any other business activities that the partner may have, the partner is going to file an individual tax return. And at that individual level is where the partnership's taxes are paid. So in this context, partnership is something called a pass-through entity, which means that yes, it has yes, it exists. It's got a tax identification number, and you have to hire accountants to prepare the tax return and prepare the Schedule K1. But for tax purposes, all the tax liability passes to the individual partners who are the people who will end up paying the tax. Another name for pass-through entity is a flow-through entity. Now, moving on to corporation, this is an entity that you definitely need to file a document with the state. It's called Article of Incorporation, and it doesn't happen by accident that the corporation is created like it could happen in a partnership or even a sole proprietorship. So in a corporation, the owners are called shareholders. The evidence of ownership is essentially the possession of the shares or stock, whether it be physically or electronically or by some other means. And the corporation is governed by board of directors who are responsible for important or strategic decisions like hiring the CEO or whether to accept a merger proposal and so on. Its governing document is called bylaws, And that document sets forth all the rules that the corporation has to abide by, including how the important and day-to-day decisions will be made. And the day-to-day management is done by the officers of the corporation, who has titles like president, vice president, CEO, CFO, and so on. And as a separate legal and tax entity, it will have its own tax identification number, uh, file its own taxes, and pay its own taxes. So now, if there's a profit, the board of directors can decide to distribute the money, and this is called a dividend. And when the shareholders receive this dividend, they have to pay tax on that too. And this is why people are, they lament that the corporations are subject to double taxation, because it gets taxed first at the corporate level, and then when the money gets distributed out through the dividend, they are also taxed at the shareholder level. Even though at the shareholder level, the dividend tax rate is a bit less than it would otherwise be typically. And this is a big negative. As for legal liability, as a complete separate entity between the shareholders, the corporation gets limited liability, which means that there is asset protection shield for its owners, the shareholders. There is a special type of corporation called Subchapter S corporation, which allows you to treat the corporation as a pass-through entity. So you fix the double taxation issue there. And then it also, the reason why it's so popular is because it allows you to save some portions of the self-employment tax, which is also called FICA taxes for Social Security and Medicare. And the way it happens is that the corporations, in the corporation, a stockholder can also be an employee of the corporation. Now you might say, what's the big deal? A corporation having an employee. That's actually more special than it seems, because you can't be an employee of a partnership if you are already a partner, or you can't be an employee of your own sole proprietorship, or if you're already a member, you can't be an employee of an LLC, especially if that LLC is taxed as a partnership or a sole proprietorship. But you can in a corporation, including an S corp. And so, for example, if an S corporation has a profit of $100,000, you can allocate 40,000 of that as salary, and $60,000 of that as a dividend, and you would only end up paying self-employment taxes in the 40 range. Now, I'm not saying that these are the right numbers, but just as an example. And then you might be tempted to ask, like, well, why do I even pay 40? Why don't I just make my salary zero and make the entire profit, deem that as a dividend? Then I won't have to pay any of these self-employment taxes. But the IRS sort of, anticipated this loophole and said that you have to pay a reasonable amount of salary or wages. And to determine that is a specific discussion that you'll need to have with your accountant. One thing I want to point out is that the corporation is a state law concept, and whether that corporation is subchapter S or subchapter C. Subchapter C is the regular corporation. That's a federal tax election. And regarding subchapter S, there are other restrictions that I should sort of mention here briefly. There is a cap of shareholders of 100 shareholders, so you can't have more than 100 shareholders in that S corp. Those shareholders have to be U.S. citizens generally. Only common stocks are allowed, so no special type of stocks, even though you are allowed to have voting and non-voting class. And there are other restrictions that I'm not going to go into detail here, but where it shines most is when there are high profits, obviously. And this is a good problem to have, but maybe not necessarily the problem that you immediately face when you create your company, because the first thing that you'll have to worry about is probably the losses coming your way very shortly. And you also have to remember that corporations, they have to file the taxes as well, in addition to paying the taxes. So there will be additional administrative burden of having to do that paperwork. So that's additional time and additional expenses for the accountants and so on. So this brings us to limited liability companies, also called LLCs, and we've saved the best for last. The best way to describe an LLC is that it's a mixture of a partnership and a corporation. So you're taxed like a partnership, but you have the limited liability of a corporation. So the default tax rule is that if there is only one member, then the LLC becomes a disregarded entity, and it becomes taxed as a sole proprietorship. And if there is more than one member, then it will be taxed as a partnership. But you could also choose to be taxed differently. So you could actually choose to be taxed as a C corporation or an S corporation by filing a form called 8832. And making the tax election is relatively easy, but once you decide upon it, to change it will require an IRS's permission. LLCs are treated when you file an article of organization with the state. In this case, Department of Licensing and Regulatory Affairs of Michigan. The owners of LLCs are called members. The ownership interest is called a membership interest, and the governing document of an LLC is called an operating agreement. And one of the best things about LLCs is that they are designed to be flexible. LLCs are governed by the state's Limited Liability Company Act. And when the legislature wrote them, they designed it to be easy to set up and maintain. And they don't have as many formalities. So there's no annual meeting requirements or the requirement to keep paper trail of the past decisions called resolutions. But if you want to, you can by electing to do so and putting it in the operating agreement. So the way the Limited Liability Company Act reads in many cases, but not all, but in many cases, it will say something like, unless, provided otherwise in an operating agreement, the rule for doing X is, B, and so on. And because of this flexibility and low cost of forming, the LLCs have become the dominant form of business organization form in Michigan, especially for small businesses. And the way I see it sort of happen is that new businesses are typically created as a limited liability company, but as it grows, it later converts to a corporation. And you could do that even to a different jurisdiction. So I often see a company converting to a Delaware corporation when it is trying to raise funds from investors, because investors will often insist on investing in a Delaware corporation. Or if the company decides to take a different route and save taxes instead, convert to an S corporation and such. And I think this is sensible, because you don't know how the business will turn out when you first started. And oftentimes I see that the premature optimization oftentimes leads to unnecessary pain and expense. So I know that was a ton of materials to cover. Thanks for watching this till the end. I hope you found the information to be helpful. And if you liked the video or learned something new, please give us a thumbs up and subscribe. And in the next video, we'll dive deeper into limited liability companies specifically, and also how to form one. Thank you, and see you there.